What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500 ETF. We're also going to talk about some stocks that we're watching for the week ahead. These stocks include names like Airbnb, Cisco, Coca-Cola, Walmart, and Tesla. We're going to talk about some key levels and price targets that we're watching for these stocks so you know the exact strategy that we're going to take on them. And finally, during all this, we're going to talk about some key reports that markets saw last week and some reports that we're expecting for the week ahead that are likely to shift the market up or down. Last week, we saw both the CPI and the PPI reports reflect a higher than expected inflation. So, for the last 7 months, inflation has been coming down, but for the first time in 7 months, inflation showed a tick back up, which scared markets and ultimately led us to move lower by the end of the week. Along with the higher inflation rate, we also saw the retail sales data that showed more aggressive buying from consumers in January. So, as consumers like you and me go out and spend our money, that's only going to create more demand, therefore raising inflation, and that will result in the Federal Reserve raising interest rates even further. So the market has not been coming down because of inflation. The market's true reasoning for coming down is higher interest rates. Higher interest rates result in economic slowdown, therefore, the market will shift lower based on key earnings from companies. Last week and the weeks before that, we saw the technology sector miss on earnings. Companies like Google and Apple missed their earnings for the first time in 7 years. So that just goes to show what higher interest rates can do to the economy. Now it's more expensive for those companies to take out loans and hire people, and it's going to be more expensive for people to go out and buy their products. And so let's talk about some key levels that we're watching just for the weeks ahead. That way we can be prepared for what's to come. If you are looking at SPY, you know that 400 has been the ultimate level for us. The last time we tried to get above 400, we failed miserably and the market went all the way down to near 370. This time around, it's looking like we're holding above it so far. However, last week, we shifted below the 20-day moving average. The last time we were below the 20-day moving average was back in the beginning of the year on January 5th. Ever since then, you can see that the market has been rallying back up. But now that we're below it, if we can't get back above it and we get rejected, that means we are likely to shift lower towards 400. So if we break below 400, we are expected to move towards 393.50 and even 387. So prepare yourself if we break below 400. Now to the upside, if we are going to move back up, it's going to take a positive note from the PCE report. So we're expecting the PCE report on Friday, which is another tracker of inflation. In fact, this is the Federal Reserve's preferred gauge of inflation because it tracks the consumers directly. And so if we see a lighter than expected inflation on that report, then we can easily shift back up. If you are looking for that shift back up, we're going to need a break back above 409.50, which is a pivotal point for the market. If we break above that point, then we have a good chance of moving towards 416 to 418.30 again. Now, 418.30 was our strongest point of rejection in the recent weeks. So if we are to move above 418.30, then we can fill the gap that we made back in August 19th. You can see there's a gap up to 421.57 that we never filled. And so if we move above 418.30, that should be your next price target right around 421. So now let's switch gears and talk about some of the stocks that we're watching for the weeks ahead. We're going to start off by talking about Airbnb, which is the first stock on our watch list. Airbnb just reported earnings and they reported their first ever profitable year. The company gapped up to a 7-month high above very critical levels, and the stock has been consolidating above that level for the last 3 days. So for a move like this, we like to apply something called the power earnings gap strategy. We're not going to explain it in this video, but we are going to leave a link for you to watch it. It's the most effective strategy when it comes to earnings, and we definitely recommend you watch it before you take on this trade. And so for Airbnb, what we're looking for now is for Airbnb to hold above the 130 level. We've actually drawn out some levels for us to watch, and you can see them here. Airbnb needs to hold above 129.14, which was the lowest point that it reached during its gap up consolidation. So on the day that it gapped up, Airbnb came down to 129.14 and it began moving back up. On Friday, the stock did pull back, but it didn't pull back below those lows, which means that the buyers that took it up on earnings are still very much holding the stock. And so for an upside move, we are looking for Airbnb to move back above 138.80 in order for it to move to a price target of around 144. If it can break 144.63, which was the highest point that it reached during the consolidation after its gap up, then we can see it moving to a price target of 150 to 152. Now, Airbnb is currently still bullish, and so although it pulled back on Friday, the stock is still very much considered bullish. So, if you are bullish and you are looking for an entry, an entry above 129.14 is fine, and it actually leaves you with a very low risk stop loss because then you can use a stop loss just below 129.14. If the stock breaks below 129.14 with strong volume, then we are potentially going to take a short or put position down towards 124 to 125. So we will play either the upside or the downside. We are leaning more bullish because a company posting a profitable year for the first time is very significant news, especially when travel is still very much strong. So we are still expecting Airbnb to pick back up, and we will watch it for the weeks ahead for it to pick back up and break into higher highs. But for now, we are watching these levels here. The next stock on our watch list is going to be Cisco. Like Airbnb, Cisco just reported earnings, and we are going to be applying the same power earnings gap strategy. Remember, the link is in the bio. Don't forget to subscribe and like the video as well. So Cisco just came off of earnings, and the company is a technology company. So technology companies just reported poor earnings. Remember, Apple, Google, and Amazon, those missed their earnings, while Cisco beat on earnings and they raised their guidance for the year ahead, which is fantastic news for a company in the tech sector that's battling those giants and it's beating their earnings. So let's talk about the move that Cisco had and the levels that we're watching for the weeks ahead. So Cisco levels to watch are going to be, first of all, 51.75. So 51.75 is the highest point that Cisco formed during real-time trading, so not after hours or pre-market hours. So during real-time trading, 51.75 was the resistance. So we're looking for a breakout above 51.75 for Cisco to move towards 53.60, which was the highest point right after the earnings came alive. So when earnings were reported, Cisco moved to a high of 53.60. Therefore, that's our first price target. Now, if Cisco moves lower, and we are leaning more bullish than bearish on Cisco, if it moves lower, then we will be looking for a break below 49.50 for a price target of around 48.50. As of right now, Cisco is bullish and we are leaning bullish on it. But remember, technology stocks took a very strong decline last week. Therefore, if tech continues to sell off, it is likely to drag Cisco down with it. Next stocks are going to be Coca-Cola, Walmart, and Tesla. We're going to go over Coca-Cola and Tesla first. So Coca-Cola is a company that also came off of earnings. So this one, it didn't have that power earnings gap that we were looking for, but the company still reported positive earnings, which makes them a bright light for investors right now. So remember, investors are looking for places to move their money to when they want to take their money out of a specific sector. So while technology stocks have been going up for the last few weeks, consumer defensive stocks like Coca-Cola and Pepsi have been coming down. And so when the money comes out of tech, it has to go somewhere else. And that is likely going to be consumer defensive stocks because these stocks have been holding up very well against inflation. So for Coca-Cola, not only are we watching it for the short term, but we are watching it for the full quarter. But for the short term, we are looking at these price levels here. So for Coca-Cola to push higher, we're looking for a breakout above 60.25. Coca-Cola is a slow-moving stock. You got to remember, this is not your typical Tesla. It doesn't move 20-30% within just a couple months. This company moves slowly because it's been established for so long, and its buyers are different buyers than Tesla buyers. And so if you are looking for a move on Coca-Cola, you're going to need a breakout above 60.25 for a move towards 61.15 and 61.65. We are already holding calls on Coca-Cola expiring in mid-March, and so we are expecting the stock to move towards the 62 level, which is going to be right around where our strike is. And if you would like to join our group and get in on these calls, we are going to leave a 7-day trial link in the bio. Now, to the downside, Coca-Cola, if it shifts below 58.95, then it would have shifted below a very strong double bottom, and it will likely cause a severe sell-off. If Coca-Cola breaks below that level, then we are expecting Coca-Cola to move quickly towards 58. Last but not least, we're going to talk about Tesla. We're going to save Walmart for a later date because they're expecting earnings this week, but now we're going to talk about Tesla. So Tesla has been a monster for the last few weeks, and it's been on everybody's watch because the stock literally doubled within just a month. So Tesla is now trading just above 200. And remember when we talked about SPY and we said that SPY has shifted below its 20-day moving average? Well, Tesla is one of the companies that has been holding its 10-day moving average. So it's not even moved to its 20-day moving average in the last few weeks. So Tesla since January 20th has not been below its 20-day moving average. So with that being said, Tesla is focused now on maintaining the 200 level. You can see that every time the stock dipped below 200, buyers were quick to buy it back up. And so if you are looking at Tesla, think of 200 as a very strong psychological level. If Tesla was to move below that level, then it can easily downshift towards 196.80. Now, if it moves below 196.80, which the 196.80 support is this support right here, so where it had that double bottom and bounced on Friday, that support, if it was to be broken, Tesla will likely move quickly towards 187.65. And if it moves below that level, then we're going to take on puts towards 175 to 180. So remember that Tesla's buying was very strong and vertical for the nearly 2 months, which means that Tesla can easily be sold off just as quick. So the more vertical a purchase is, the more it can shift downwards quicker. So if Tesla was to move below 197, then it can easily free fall. If you are looking to the upside on Tesla, then you're going to need a breakout above 217.82. If the stock moves above that level, then we're expecting a short squeeze first to 225, and the second price target would be 234. So that's all that we have for you guys. I hope you enjoyed the video, and best of luck in your trading week.